On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice and it doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners financial advice provider disclosure statement, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Please engage with us. We love to get feedback, questions, and comments on this material, and if you enjoy it, please rate it, or even better, share it with a friend or colleague. After 2 consecutive years of 25% plus returns, the US share market has hit a few speed bumps in 2025. The S&P 500 index is down 2.5% so far this year, and it's looking a little wobbly as investors fret over the threat of tariffs and trade tensions. However, as they say in investment circles, there's always a bull market somewhere, and right now, that somewhere seems to be Europe. European shares are up more than 10% this year, led by Germany, where the DAX index has surged 15.6%. That's its best start to a year in at least a decade, but the question now is whether those gains will keep on coming. A key reason for the robust performance has been attractive valuations. Investors have been lukewarm on Europe for a few years now, and major indices in the region have been trading below their long-term averages. With the US market rising more than 50% during 2023 and 2024, it's been very easy to ignore the rest of the world. However, those stunning gains have made US share prices start to look a little pricey. Excluding the abnormal COVID period, valuations relative to earnings have reached the highest levels since 2002. Now that's clearly skewed by the Magnificent Seven, which account for about a third of the US market and have genuinely better growth prospects due to developments in artificial intelligence. While that does make an apples with apples comparison with the past more difficult, investors are wise to assume that the gains will slow from here. This renewed interest in non-US shares has led to a re-rating of the European market, which is now trading in line with its own long-term average. However, for the strong start to the year to be sustained, we might need to see a cyclical recovery in the European economy, as well as some much-needed structural changes. There's a decent chance that happens actually, which does make the European share market look more interesting than it has in some time. We've seen the beginnings of a rebound in consumer confidence over the past 2 months, which does bode well for the excess savings pile that exists in the region. Lower interest rates will also be helping, and that could spur an increase in bank lending. The European Central Bank, the ECB, has cut its policy rate 6 times from a Euro-era peak of 4% last year to 2.5% today. It's expected to fall further, which could have a big impact given Europe's traditional preference for floating rate loans. Another potential catalyst could be a resolution to the war in Ukraine, which is something we'd all like to see. That would boost confidence and it could see the return of cheap Russian gas. That would be a boon for the manufacturing sector, which is still in contraction but is steadily improving. Europe's manufacturing PMI, which is a useful activity indicator, hit a 2-year high in February, and the factory sector has come close to stabilising. We've also seen some potentially game-changing announcements out of Germany in recent weeks, with leaders of the reigning political parties agreeing to abandon years of cautious fiscal policy. The debt-funded injection into the country's security architecture and infrastructure sector has come in response to years of underfunding, as well as question marks over America's future commitment to assisting the region. That's pushed longer-term bond yields higher and prices for those bonds lower, but it's a genuine positive for economic activity, corporate earnings, and therefore the share market. On the other side of the coin, tariffs loom large as a threat to the wider European economy. The US imposed steel and aluminium tariffs on the EU starting this week, while the car industry is bracing itself too. That will undoubtedly be a headwind for growth, although some experts believe that the US could also end up importing more from Europe in place of imports from China, Mexico, and Canada. Tariffs could also unify Europe and drive reforms, which would be great to see, as hopeful as that might be. After living in the shadow of the US market for some time, the prospect of attractive returns from across the Atlantic might just be looking better than they have for some time. Thanks for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.